Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello and welcome to Live Squawk's Market Talk, our weekly review on Monday, 27th of July, 2026. This is the briefing aiming to break down the key stories from the past 7 days and explore subsequent implications for the markets. We'll also look ahead at what's to come, giving you a heads up on the events and data points to watch out for. Listen in on our social media platforms, or you can go back on one of these podcast platforms and listen from the start. Today, I'm joined by two regulars, Ryan Littlestone of Forest Analytics. Hello, Ryan.
Morning, mate.
And Michael Brown, market researcher, analyst, who's, we've heard from him quite a bit on this show, and he gets a really good sort of response from our listeners. So, Michael, how are you?
Very good morning to you, mate. Not too bad at all, thank you.
Awesome. Before we get cracking, just a quick disclaimer then. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries a risk, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following content on this channel. Right, we'll get straight into it then, because there's quite a lot to pack in, more so in the weekend, going over what's to come in the week ahead. But we'll have a quick look at some of the past sort of markets relevant sort of events. So we'll start with, obviously we had Kevin Walsh last week in his testimony. Not too much said by him. I think that was of particular interest. But we do have obviously an FOMC meeting this week, so there's a relevance there as well. So we'll get that bit out. We'll come back. We'll get that out the way now, I guess. So we'll start with Ryan. Ryan, your views on what we heard from Mr. Walsh.
Yeah, as you said, not a lot really. We're all waiting on his task forces and what they're going to do and decide about how the Fed should set their framework and everything else, what data points they're going to be looking at. Not too much on the policy front, though. We did do a little bit of pushing back that perhaps he's a political puppet for Trump. So he's not, sort of not afraid to make decisions that might go against what the president wants, which you'd expect him to say that. I don't think it's put too much light on the upcoming FOMC, but he's sort of in that honeymoon period still, where he's still got a tiny bit of rope until the next FOMC this week, before the market starts going, okay, you keep telling us what you're going to be doing. We need to know exactly what you're going to be doing with future moves at the Fed, policy and framework and the like.
Yeah, fair point. It wasn't really much of a. Normally, those we used to call them Humphrey Hawkins testimonies were a sort of go-to event over the 2 days. But if he has his way, I guess they're going to be less revealing alongside any sort of FOMC communique from now on. Right, moving on, because I want to crack on to the week ahead. Mike, ECB meeting last week kept rates on hold. As expected, really wide expected, but with renewed worries over the energy situation in the Middle East now, and oil prices starting to rise again. Do you think we got a definitive sign that they're ready to move in September?
Yes, indeed. I think that's pretty much nailed on, to be honest with you, regardless almost of what happens with energy prices. You had those sources reports coming out after the meeting that were pretty explicit in saying that officials are said to be ready to raise rates in September. You even had a handful of officials who were thinking about raising rates at the meeting that we had last Thursday, according to President Lagarde at the post-meeting press conference. And also at that press conference, she actually said quite explicitly that the full effect effects of this energy price shock on inflation in the euro area have yet to play out. So although the ECB didn't raise rates or do anything on the policy front last week, I think they've really laid quite a solid foundation and quite an explicit foundation that they're going to pull the trigger on a hike next time out when they come back from their summer break.
Yeah, like you say, the markets were, I think they were about 50, 60% beforehand for September. Maybe I'm getting that wrong, but potentially higher. But I mean, there's even, odds we'll get, like you say, maybe potentially 2 hikes coming before year end, although I think that's, for many, that's a bit of a push.
Yeah, I think that is a push, because that would take you above the top end of where the ECB think the neutral rate lies, which is somewhere between 1.75% and 2.5%. So the logical thing to do if they do see a need to tighten is to tighten right to the sort of upper bound of neutral, and then sit on your hands and wait and see what happens. And of course, you'd hope that by the time we get to September, there might be a little bit more clarity on the geopolitical front to help their decision making as well.
Yeah, absolutely. We had a fair amount of data out of the UK last week, and I'll come to you again, Ryan, on this one. CPI, labour market report, retail sales, as GfK consumer confidence and stuff. Where do we sit with the UK economy? Bearing in mind we've got a new Prime Minister now, we'll talk about Burnham and his new Chancellor as well. Where do we sit at the moment from an economic perspective? Because there was a bit of a surprise from the GDP, and surprise is probably a strong word, but we had a decent turnout for GDP. So economic activity was better than expected. Retail sales were also fairly keen as well last week.
Yeah, well, everyone's been buying fans and whatnot for the month, so that's pushed everything up. But yeah, I mean, the data's still holding up. I mean, obviously CPI, that followed pretty much the same route as everywhere else, maybe to not quite the same extent on the core numbers. Everyone's seen inflation coming back in June because we've seen oil fall $70 in the space of a month. So that's washing out some of that energy inflation. And yeah, the rest of the data, it's okay. Yes, it was, slightly better than expected on the GDP, but again, we're not in any sort of boom conditions. I actually think that so far, from what I can read from Burnham, because there's always two opinions, public opinion, market opinion. The public opinion thus far seems to be that maybe he's going a bit far to say he's a breath of fresh air, but compared to the last plank, he's certainly a bit more energetic and talking a good game. The market, I think, is a bit more sceptical. But just on the public opinion side, I'm big into sentiment, and I think if people think that this is a positive move, putting Burnham in, things are going to get better. We could see a little bit of a pickup in consumer related side of the economy, at least, maybe even the business side of things, just as maybe a bit of short term things might not be as crap as they were under Starmer, sort of relief type thing. So we could see the data getting marginally better for a short period. But he's got all these plans. They keep getting picked apart every time he drops them about how they're going to be paid for. And that's
by his own party as much as anyone else.
Yeah, yeah, and that's the other side of the coin. What the market does with it, and I think it's a little bit more sceptical at the moment.
But I think the other thing I would add just on that, and I agree, by and large, a lot of the stuff Burnham has announced so far does seem to have been received relatively well in the public eye. But I think it's important to also recognise that what he's announced so far is largely giving money away, whether that be, capping bus fares, removing VAT off energy bills, et cetera, et cetera. The policies that are going to detrimentally impact the approval rating or the public perception of the Prime Minister are going to be the ones that outline how the hell all of this and various other commitments, such as increased defence spending, how that's going to be paid for. And quite wisely, Burnham has decided to sort of go with the good news first and hold the bad news back, but it's going to have to be delivered at some point, whether that be next week or in the run up to the budget or at the budget itself. So I think any sort of uplift to sentiment could indeed prove to be somewhat short lived.
Yeah, absolutely. I think you're right. I'm talking maybe a month or two that we see maybe that uplift. But yeah, he's trying to kick the can to the budget for a lot of this stuff, but he's not going to be able to because the market's going to keep pushing and his own MPs are going to be pushing and the opposition are going to be pushing. You want to bring out these plans till they say you're paying for it.
Yeah, fund it. On that note, how have the markets taken it to date? Ryan, I'll come to you first.
Yeah, I mean we're in this period again where the pound has been a bit resolute. It did have a little bit of a sell off last week, mainly in cable and euro sterling. But that that was a sort of after we had a decent rally in both. Cable side is obviously what was going on in the dollar, but euro sterling, we seem to have bottomed out in that low 85s, 84.90s, 80s. And now we're probably in a bit of a waiting game to see what happens and whether the market is going to get behind him and his plans and whether it can be paid for. What would, I think, be a bit of a kicker for the market is if he decides that he needs to borrow more or use this wiggle room he thinks he's got. And it's for investment, it's for growth measures, because we had absolutely nothing of that in the last budget, and the OBR actually put that in their statement that there was no growth boosting measures in that budget. If he changes tack and starts putting in things that might get the economy going, the market might give him a little bit of leeway on if he has to do any extra borrowing, maybe even any extra tax rises, because that would be a bit of a shift from the last one from accounts.
Oh, this is and this is the thing that there's been missing, just like you said, the growth element. Everyone's keen. No one wants to pay more, but you need to know how the country's going to, feed itself over time, effectively. And that was a worrying bit, but not worrying so much. But again, that's been missing from a lot of the communication we've had with the new number 10.
Yeah, and that's been the surprise with the market, that we have seen. Okay, you can look at yields, that might be telling a slightly different story, but
that's more global story, isn't it? The yield
yeah,
story, really.
Yeah, but there's still a bit of political premium on top of that as well. But the pound, as I say, it's held up pretty well because the market has gone with the line. Well, Rachel Reeves was fiscally responsible, even though there's no growth to come along with it, which I've always found strange in this situation, which is why if Burnham does go down that road, then we could see the pound doing a bit better as well on top of that.
Right. Michael, do you have anything to add to that?
No, I think that's pretty much spot on, to be honest with you. I mean, I think the other thing, of course, is that one factor that probably does explain sterling's relative resilience is the fact that we avoided the scenario, the nightmare scenario of Ed Miliband running the Treasury, because, of course, that job went to John Healey, which was a surprise in terms of him getting the gig. But nonetheless, I think it was an appointment that markets, to an extent, welcomed, because it's not the fella who's had this radical energy policy that's cost the country goodness only knows how much over the last couple of years. So that will also have helped. But I agree with you. I think getting a read from gilts at the moment is pretty difficult because, of course, everything is basically being skewed by energy prices.
Yeah, absolutely. I mean, it could be a very shrewd decision to bring in that respect. But I think also Miliband is more left leaning, which may well have scared the markets to a degree as well. That and his bacon butter eating.
The less said about that, the better.
Yeah, look it up, someone.
Playing his guitar out to buy a windmill.
Yeah, and the fact he turned over his own brother to get we could go on, but we'll leave it at that. Right, let's look at the week ahead, because we have a packed week to come. And we're headlined by a FOMC decision in one sense, because the largest central bank of the largest economy in the world is meeting to decide policy on Wednesday. We're looking for unchanged rates, keep rates in the current range. What would you be looking for and bearing in mind that we just discussed Walsh and the fact he didn't really give a lot away at the semi-annual testimony on Capitol Hill. Mike, I'll start with you on this one. What are you expecting from the decision Wednesday?
Well, not a lot, to be completely honest with you. I mean, I don't think that the Fed will raise rates. I think they will stand pat in terms of the Fed funds rate. Although I wouldn't be at all surprised if we did have a couple of hawkish dissenters. Obviously, Hamack and Logan have been talking about the potential need to tighten policy in recent public remarks. So perhaps they'll sort of put their money where their mouth is, for want of a better word, and dissent. But I don't think you'll have a majority in favour of that decision. And that's really all we have to get our teeth into with the FOMC these days. I mean, you go back to the June meeting, the statement that was issued after that confab was about 100 words long, which is about a third of the length that we were used to under Powell, and of course contained nothing by way of explicit forward guidance. Kevin Warsh, the chairman at the press conference, is not going to give any explicit forward guidance himself. We know that at this point. I think any difficult questions, he's again going to defer to these task forces that he's set up on those 5 key areas, including things like inflation measurement and communications. And I think ultimately what the Fed are really trying to do is just play for time, not necessarily in terms of trying to gauge greater clarity on the geopolitical backdrop, but also gauge greater clarity on the domestic inflationary backdrop as well. Of course, we had that really soft June CPI number, headline CPI falling on a month-on-month basis, flat on a core basis. And I think the Fed are really going to just want to assess more data before they decide their next move. And I think the totality of the data that we had between the June and the July meetings does suggest that they should stand pat, even though I think markets are pricing a 1 in 3 chance of a hike on Wednesday night.
Yeah. There's actually pricing some of that in, which is a little bit of a surprise to me. But that's what the market thinks. That's what the market thinks. Just to note, I've got a note from HSBC here on this that says they'll be looking at 3 things: the number of dissents, as you say, Walsh's characterization of policy discussion during the press conference, and they mentioned the fact that we've had 3 dissenters in the Dallas, Cleveland, and Minneapolis Fed. All against an easing bias. So they'll be looking at the language to see if there's anything coming from that. They say another complication is that policymakers are assessing at least 3 factors that are contributing to elevated inflation: strong AI-related demand, conflict in the Middle East, and the effects of tariffs. Moving on then, because we do have our first look at Q2 GDP, preliminary from there. We've seen the resilience of the US economy, and again, some of that may be eroded from the higher energy prices that we've seen. But the US economy seems to be rolling on regardless on that front. I want to talk about the energy discussion next, because Trump's latest taco, after vowing to take out the leadership again of Iran, he's now, I think we're in our 3rd day of a cessation of violence, shall we say. When will this ever end, this turmoil? Honestly, because it's starting to drag now a little bit. Wars are never nice, but this is just becoming a bit of a, what's the point? Is my question, Ryan, on the Trump turn of events again.
Well, the point is he started it and he can't back down. And you could go right back to the beginning. Was he right or wrong to start it? It should have been Europe's problem, but they weren't going to do anything about it. So he's had to step in, and now he can't step out of it so easily. And it's difficult because we got this ceasefire. We pick your reason. They're running low on ammunition or whatever. But this has been coming. Because he had to make a decision either to escalate things now so he could calm things down in time for the midterms, or he looked for an off-ramp. I'm not sure what we're going to do with this ceasefire, whether it means we go back to the MOU ceasefire, which has still got 3 weeks left on it. So we're still in this malaise. It seems like Iran just doesn't want to do anything, and they're happy to play it out. They're happy to game it out.
That's been their point. They can wait this out, and they've shown that.
Yeah.
And it's almost like when you speak too much, you're going to get yourself into knots, and they're letting him do all the talking.
Yeah,
and they're living off the back of his sort of policy mistakes in some respects.
Exactly, and they can wait and wait and wait and wait and wait. They know that he's got the midterms coming up, and despite him saying, in the last couple of days that it doesn't matter about those, he will be thinking about those. We've had talks amidst the people in our chat room that a possible off ramp for him is blowing up this Pickaxe Mountain or whatever, claiming he's knocked out all the nuclear dust and everything, and that gives him maybe a bit of an out, but. We'll see what this phase does, this ceasefire, whether it leads to anything permanent, or whether he's going to scale up again, because I still think that's on the cards. And for energy markets, yeah, we've seen a big sell-off, and it's a bit strange because oil markets seem to like or want to sell off faster than they go up on no news. This is a potentially temporary ceasefire. It doesn't change the picture. It puts us no further to a deal. But you see oil coming off $12-14. It's a big move, and then it's a bit more hesitant at times to go up on bad news. It will go up in sort of steps. But the connotations, the main connotations for this, I think, if we are in an escalated period now, this is where oil will make a more sustained move higher than the sort of volatility that we got in the first phase, and that's going to be the issue for central banks like the ECB and the likes.
Yeah, talking about central banks, let's take a look at the Bank of England. We've got key policy decisions. I wouldn't say key for the Bank of England necessarily, but I think they're all kind of key now with the geopolitical situation we have at hand. We'll come on to Bank of Japan in a minute, but Bank of England set to meet this week. Analysts expect a 7-2 vote for a hold, and a maybe more neutral or central forecast, says Morgan Stanley. Well, this might prove a challenge. We see attempts to anchor market expectations a bit more on the risks around second round effects and less on commodity prices themselves, which obviously we know are volatile and don't make up the whole of the inflation basket, but obviously play a key part in that headline figure. Mike, what are you looking for from Bank of England?
Yeah, I mean, obviously, there's not going to be any changes on the policy front. Bank rate is going to stay at 3.75%. That's pretty much a given. I wouldn't be surprised if it was a 6-3 vote, though. I think, obviously, Chief Economist Hugh Pill and external member Megan Green are going to continue voting in favour of a 25 pip hike, as they have done for some time now. But I think there's a decent chance that they're joined by Catherine Mann. She was speaking at the start of July, talking about how a more activist approach, her words, not mine, would ensure a swifter return to the 2% inflation target. But even if she were to dissent, I don't think that her views are representative of the remainder of the committee. So there's not much signal that we can extract from that. I think really the key thing for the BOE will be the forecasts that they issue. Where do they pin inflation peaking later this year? Of course, bear in mind that they're not going to take account of the rise that we've seen in energy prices over the last week or two, so they are somewhat stale by the time they're published. But
do you want to just explain to listeners why that is? I mean, because they've calculated this based on.
Yeah, so basically what any forecasting authority has to do, of course, the Bank of England in this case, is they need to basically take a snapshot of financial markets, whether that be oil prices, natural gas prices, the sterling exchange rate, bank rate expectations, all the rest of it. They need to take a snapshot of that at a fixed point in time, and then use those fixed numbers in the rest of their calculations and modelling that goes into the forecast. So you have to take that 3, maybe 4 weeks before the forecasts are published to enable all of the boffins and the econometricians to do what they need to do with those numbers. You can't simply take, wherever the front Brent contract is trading on the morning of the decision. It's a little bit more complicated than that.
Yeah, fair enough. And we saw the example of that with the ECB.
Yes.
The last day of their meeting, then we had this more developments going on in the Middle East again.
But I think just to go back to the bank very quickly, I think the big thing for the MPC is still what are the risks of second round effects in terms of higher energy prices resulting in employees asking for faster wage increases, etc., etc. And I think those risks are still pretty low. I mean, we had the latest jobs numbers last week, and there's still plenty of slack in the labour market. Private sector earnings growth is 2.9% on the year. It doesn't there's not really anything there that suggests that they need to be adopting a tighter policy stance, I don't think.
I'm going to. Well, I'm not going to disagree there, but I think you're right. But I think it's the fuse has been lit. I mean, I think that the BOE played it right with not getting too excited about hiking rates, because this could just be a temporary blip in oil prices, and that got proved right in May when we saw the big drop off. This second round, I think this gets them more cautious. I think it gets every central bank more cautious, because people just saw pump prices coming down, and now they've seen them go up again. And I think this is where it potentially gets dangerous for things like wages if this situation is more sustained and higher energy prices are more sustained. You're going to start seeing people pushing for higher wages to combat it, because it's not going to be a short-term shock.
Maybe, but I think bargaining power is quite limited in a labour market with, unemployment at 5% and the other metrics pointing to quite a significant degree of slack. Employees might ask for higher wages, but whether they get them or not, that's a different story.
Yeah, but then the public sector is a different story to that as well. And we know what they're like, strikes and pay rises and the like.
Very true.
Again, just listening to your discourse there, you can see there's still a lot of factors to play into the bank's thinking. Talking of factors playing into bank thinking, Bank of Japan, we want to finish on the Bank of Japan. We've seen the yen moves of late, and we've seen maybe people just over-egging what the expectations are of the yen at the moment, and it's just failed miserably on a lot of fronts. We've got Bank of Japan decision. I think the consensus is they'll leave rates alone, but we have had communication in the last few weeks, last couple of weeks, to suggest they're moving from a biannual rate hike to quarterly. We didn't get a great deal of reaction in the market, it's fair to say, but we've seen a lot of action in the yen or inaction of the yen of late. I'll come to you with this, Ryan, to round us off. What are your views on the Bank of Japan and the yen plays we've seen of late?
Yes, I mean, the sources pieces have been constant that they're not going to likely to raise at this meeting, but I think we're probably close to getting an indication from the bank what they're going to be looking to do over the months ahead, and I wouldn't be surprised if they tee up another rate hike for the following meeting or meetings. I think a bit like the BOE, I think the votes are going to be important. Can't remember if we got 2 or 3 votes for a hike last time, but if we get 3 votes, that certainly puts the line closer to them hiking, and maybe they indicate that they are prepared to hike, as we saw from rumours last week, faster than once every 6 months. Not that once every 5 months makes much difference, but in Japan, that's a 20% change in your thinking, and that's big. So yeah, I think they're starting to get the economy going the right way, so the economy can start wearing hikes, whereas that would have been harder with growth not doing as well as it was, or the economy not doing as well as it was. So it's going the right way. I just still don't see anything coming that changes the tone of the yen, unless they really start heating up in the economy and Takeichi's plans, really start bearing fruit. But that's still 6, 9, 12 months down the line before we really start to see that.
Mike, what would you like? Anything to add on that?
No, I think the only thing I would add is, there's all of these sources stories that we had around, are they going to hike faster than once every 6 months? It's more the signal that would send than anything else, because of course, we've been saying on this program, and various other, market commentators have been saying for a while now that, one of the things that is preventing the yen from strengthening significantly is that the Bank of Japan have been so reluctant to do anything other than hike at this glacial pace. Even though in reality, hiking at every 3rd meeting as opposed to every 4th meeting isn't going to make that much difference to the economy. It's more the message that sends to the market, which is actually, we are happy to speed things up. We are happy to, take the handbrake off a little bit, which I'm not saying that, dollar yen's going to trade 150 tomorrow as a result, but it just, slightly weakens one of the bearish factors behind the fall that we've seen in the yen in the last kind of 6 months or so.
Yeah, understood. I've got noted with JP Morgan that says they say the key focus will be whether the Bank of Japan signals an intention to adjust the pace of policy normalization in response to changes in its economic and inflation outlook. They say this will be assessed by comparing outlook reports, projections with the tone of the policy statement and Governor Ueda's press conference. This is JP Morgan continue to expect the next rate hike to come in October. So again, it's all, you've got to look through the reads again with BoJ and try and understand their way of thinking, which has given everyone a headache over years.
Yeah, you say that again.
Yeah. Right, we're at the end of the episode now, and so there's a lot to pack in. You can go to lifebook.com and find some research on the key data points from the week. You've got the week ahead, the focus on the week ahead up there. We'll also put up the links to our two guests, Michael Brown. Michael, thank you very much for your participation today.
No, pleasure as always. Thank you, mate.
And Ryan Littlestone of Forex Analytics, thank you very much.
Yeah, thank you. Nice to see you again, mate. And you, Michael.
That was a direct. Anyway,
what happened there?
He's trying to be nice to you. Come on.
Well, thank you, mate.
It's not as usual.
Well, he had his bout of niceness from me at lunch on Friday, so we could save that for another 6 months now.
Yeah.
That was niceness. Bloody hell, mate. Your nastiness.
He clings on to anything. All right,
beggars can't be choosers, mate.
True, very true. Thank you very much, but thank both of you for your wisdom on this anyway. But and again, anyone can listen back to this as and when on the socials or on the podcast platform of their choice. Thank you both. Listen, have a lovely week, everyone. Make money and stay safe, and we'll see you again soon.